Hey everyone, Assalamu alaikum. Welcome back to T Accounts. So in this video, we'll be solving A-Level Accounting June 2024 paper 13, which is of 1 hour and we have 30 questions in it. So let's begin. The first question says, what are the advantages of being a sole trader, right? So we have to look for two advantages of being a sole trader. The first one is ability to make quick decisions. Yes, this is an advantage because if you have partners with you or if you have shareholders to consult with, so that slows the decision making process. So being a sole trader, this is an advantage that you are the sole decision maker of your operations of your business. Second is no bank borrowings are needed. No, this can't be right. This isn't right at all, because bank borrowings can be needed and they can be taken by the sole trader. Bank borrowings can also be there in case of partnership or even in companies. So that is an allowed source of finance for sole trader, and that is there. So this is not an advantage. Third is owner keeps all the profits. Yes, this is also true, because you are the sole owner of the business, so you keep all the profits. Fourth, an unlimited liability for debts. This is true, but this is not an advantage, this is a disadvantage, that you are liable for all the debts of the business. You have to settle the debts even if you have to sell your personal assets to settle the debts. So that is unlimited liability, which is a disadvantage, not an advantage. So 1 and 3 only, option B. Second is, what is not a purpose of ledger accounts? Not a purpose means 3 will be the purpose of preparing ledger accounts, that is basically T accounts, and 1 won't be. So we have to look for that one. So the option A is to assist in the preparation of financial statements. Yes, this is true. And when we prepare T accounts, when we record all the transactions in the T accounts, they are then balanced off. A trial balance is prepared, which helps in the preparation of financial statements. So this is right. Second is the same thing, to assist in the preparation of trial balance. Yes, without T accounts, we can't prepare trial balance. So this is also correct. Third, to report the double entry from the subsidiary books. Yes, subsidiary books are the day books. Whenever a transaction is occurred, it is first recorded in the book of original entry, in its book of original entry, and then from there it is posted to its respective T accounts. So yes, double entry is completed when posting is done in the T accounts. So this is also right, which means that option D won't be a purpose of preparing ledger accounts, which says to verify the accuracy of the bookkeeping system. To verify the accuracy, to verify something, you should have something to compare it with. And while making T accounts, that is just a basic step of bookkeeping. Bookkeeping is actually preparation of T accounts. So T accounts have to be made, and to verify them against something, for instance, we need control accounts, we need bank reconciliation statement, or even trial balance is required to verify the bookkeeping process. So T accounts on their own can't be used to verify the accuracy of bookkeeping system. We have to have something to check them against. So this is not a purpose of ledger accounts. Number 3, an item is included in financial statements because it affects the interpretation of the financial statements. Which accounting concept is being applied? Now the key word here is it affects the interpretation of the financial statements. In options we have 4 concepts: consistency, materiality, money measurement, and substance over form. Let's quickly go through all these 4. Money measurement, for instance, says that any transaction should be expressed in monetary terms, so that they can become part of the ledger accounts. And there are some non-monetary aspects of the business, but they can't be included in the financial statements. For instance, business reputation, skills of the workforce, even customer satisfaction, that can't be shown in the financial statements because that is subjective, and getting a valuation for that is a bit difficult. So is this related to interpretation of financial statements? No. Right? It doesn't affect the interpretation because that is subjective. It is subjective, it won't be included. Second concept we have is consistency. Consistency says that transactions of a similar nature should be recorded in the same way in every accounting year so that the comparison is meaningful. For instance, we have depreciation policy or depreciation method that is adopted. It should be consistent from one year to another year, so that a true and fair value of the accounts can be reflected. So this is again not how the concept which affects the interpretation of financial statements can be applied. This is something that should be done. Third concept we have is materiality. Materiality says that include that information whose omission or inclusion or even misstatement could influence the economic decisions of the users. Why? Because if I could change the way in which people would read and interpret those financial statements, so I should include that information which is material to the decision makers or to the users of the financial statements. For instance, a very famous example is of a paperweight or even calculator, that it is an asset, a non-current asset used in the business, and it usually have a life of more than 1 year. So having a life of more than 1 year makes it a non-current asset, but it isn't included as a non-current asset in the SOFP because too much detail in the accounts would obscure the view. So it is treated as an expense in the income statement, right? Of course, it depends upon the size of the business and the operations of the business as well. Some might treat this as a non-current asset, usually the smaller businesses, but some won't. So this is the concept which affects the interpretation of the financial statements by including or by not including some information. So this is our answer, but let's have a look at substance over form as well. Substance over form says that the economic substance of the transaction should be recorded rather than its legal form to give a true and fair view of the business, of the treatment, right? For instance, a very famous example in this also is of hire purchase, right? When you rent a property or rent a non-current asset to be used in the business. So this is the legal form that you have rented that non-current asset. You haven't purchased it. Although you are making regular payments, you are using it. You are the one because of which the asset would also be depreciating. So even if you haven't paid for that asset, the concept says to show that transaction as a non-current asset being owned by the business in the statement of financial position. Why? Because this is the substance of the matter. The practical view is preferred to the legal view in the accounting treatment. So you will show that as being owned by the business because you are using it, you are getting benefits from it. So this isn't again related to the interpretation of the financial statements, but this transaction should become part of the statement of financial position, hire purchase agreement. So our answer is materiality. Moving towards question number 4, it says a business acquired new factory machinery costing 120,000. This amount was included in the non-current assets and depreciation of 10% of cost was charged in the draft statement of profit or loss for the period. Right. In addition, the business paid $14,000 for installation of the machinery and $6,000 for insuring the machine. These amounts were treated as revenue expenditure for the period. Okay. The draft statement of profit or loss showed, for the period showed a profit of $50,000. What is the revised profit? Okay. So we have cost, and we are told that depreciation has also been charged on this cost. However, we are also told that the business paid two more expenses. The first one was installation and the second one was insurance, and both have been treated as a revenue expenditure. So we know that installation expense is not a revenue expenditure, it is a capital expenditure because if this is not incurred, the machinery couldn't have been used. You can't use a machinery without installing it. So this expenditure has to be done to bring it into a usable condition. So this is a capital expenditure. This should have been added to the cost of the machinery. The total cost should have been 120,000 plus 14,000. So this expense should have been treated as a cost. Now if it is being treated as a cost, I should charge depreciation on this part of the cost as well, which would be $1,400. My additional depreciation of $1,400 would reduce my profit by $1,400. This should have been done, but this hasn't been done yet, so this is how it will be corrected. The second one was insurance of 6,000 was treated as revenue expenditure. This is correct treatment. Why? Because insurance is an yearly expenditure, and all the yearly expenditures are recorded in the statement of profit or loss as expenses. So this is right. But on this cost, it should have charged depreciation, and that will reduce the profit. Moreover, there is another impact of this 14,000, that it was treated as a revenue expenditure, means this was deducted from the profit. It reduced my profit by 14,000, but now we know that this cost should have been capitalized. So I will have to add this cost back to the profit because it was previously subtracted from it. So this will give me a revised profit of 62,600. Option C. Question number 5. Jake sold a non-current asset which was not fully depreciated. He mistakenly recorded this by debiting the bank account and crediting the sales account with the sales proceeds. What was the effect of this error? Okay, so when there is a disposal in the business, we know that we have to record the disposal using 4 transactions. The first one is to write off the cost by crediting the cost account and debiting the disposal account. Second is to write off the depreciation by debiting depreciation, the accumulated depreciation charge so far on that non-current asset, and crediting the disposal account. Then third is to record the disposal proceeds. Bank or cash is debited, or even if it's a receivable, that is debited and disposal account is credited, and then the difference between the two sides would either be a gain or a loss. So in case of loss, the disposal account would be credited, and in case of profit, the disposal account would be debited. But what did Jake do? He, instead of making all these 4 types of double entries, he just debited the bank account and he credited the sales account. Should sales account have been involved in the first place? No. Sales account only records sales of goods, that is sales of inventory. This isn't a sale of inventory, it's a sale of non-current asset, it's a disposal of non-current asset. Sales account shouldn't have been involved at all. And by debiting bank, he did the right thing. He should have debited bank account with the disposal proceeds, but not the sales account. So what he didn't do? He did not eliminate the cost of non-current asset from the cost account. He should have credited non-current asset account to eliminate the cost, and he should have debited the disposal of the non-current asset account. He did not do that. So he hasn't eliminated the cost of the non-current asset from the non-current asset account. What would be the result of this? My asset which I have disposed of will be shown in the cost account. That will overstate my non-current assets. And secondly, he recorded the transaction in the sales account. So he overstated the sales as well. By overstating sales, his profits will also be overstated. So where can I find these 2 impacts? Assets will be overstated, yes. Assets were understated, no. He did not eliminate, he did not write off the cost, so assets were overstated, not understated. Profits are overstated, yes. Profits will also be overstated because of overstatement of sales. So 1 and 3 only. Option A. Number 6. Sarah bought a non-current asset. Depreciation was provided at the rate of 10% per annum in years 1 and 2. It was sold at a profit in year 3. Very good. The policy of the business is not to charge depreciation in the year of disposal. Okay, and now the question is, how would profits be affected if the rate had been 15% per annum? Rate currently is 10%, and Sarah charged depreciation of 2 years, year 1 and year 2. She sold that in year 3, and there was no depreciation charge in year 3. Right. Now the question is that what would be the effect on profits, and that too profits in years 1 and year 2 and profit in year 3 if the depreciation rate had been 15%. Interesting. So we know that in using 10% rate, depreciation was charged for 2 years. So can I say that at the time of disposal, the cost of the non-current asset was 80%, or the net book value would be 80% of the cost at the time of disposal, because depreciation would have been charged of 2 years, so 10% each year. So net book value would stand at 80% of the cost. Right? This means that if I just make a T account, so my net book value would be at 80%, and the question is saying that there was a profit in year 3, so it was sold more than the net book value, assuming that it was sold at 85%. The net book value was 80% of the cost, it was sold at 85%, just an assumption. This means that 5% was the profit. Okay, now keeping these some of the figures same, now let's assume when the rate is 15%. So after 2 years, my net book value would stand at what percentage of the cost? 70%. Why? Because 15%, 2 years of depreciation would have reduced the net book value at 70% of the cost. So if I again make a T account, disposal account, my net book value would be at 70%, and keeping this percentage same, there was the disposal proceeds were 85% of the net book value. This means that there is a profit of 15% in third year, right? So since no figures are given, no amounts are given, we have to work in some percentages form. So if higher depreciation is charged, I know that my net book value would be lower because of the increase in percentage rate by 5%. So profits in year 1 and year 2 would be lower because higher depreciation would be charged. So option could be C or option could be D. But profit in year 3 because of the gain on disposal would be higher than the rate 10%. Why? Because that increased the difference between the net book value and the disposal proceeds. So if the rate is higher, profit would be higher in the year of disposal. That means option C is correct. Moving towards question number 7, it says a business buys a vehicle for 10,000 on 1st January year 1 and sells it for 6,500 on 1st January year 3. Okay, so it was bought in year 1 and it was sold in year 3, but on the first day of year 3, so it was kept for 2 years only. Don't get confused that even if it is written in bold, it was there for the whole year. No, it was sold on the first day of third year. And further it says the business has depreciated the vehicle at 10% a year using the straight line method. The business provides for the year depreciation in the year of purchase and none in the year of disposal, right? Question: which amount for profit or loss will appear in the disposal account, and on what side of the disposal account will it be shown? So we have to find out the gain or loss on disposal. Easy. What is the cost? 10,000. That will be debited in the disposal account, and disposal proceeds are given. Yes, disposal proceeds are 6,500. That would be credited, and we have to write off the accumulated depreciation. That would also be recorded on the credit side. So it was there for 2 years, and the depreciation policy is 10%. So on 10,000, 10% would have been charged for 2 years. That would give me a depreciation of accumulated depreciation of 2,000, meaning that there is a loss on disposal of 1,500, as this is the balancing figure on the credit side. If there is a profit, that appears on the debit side. But since it shows that the net book value at the time of disposal was 10,000 minus 2,000, 8,000 was the net book value, which is higher than the disposal proceeds. So there is a loss on disposal of 1,500, which would appear on the credit side of disposal. So option A. Next question is question number 8. Which errors would be identified by preparing a trial balance? So we have to look for the errors which will be revealed by the trial balance. Which errors won't be revealed by the trial balance? Those are error of, for instance, omission, commission, principal, compensating errors, error of original entry, etc. These errors aren't revealed, so we are not looking for those answers. We have to find out the errors which will be revealed by the trial balance. So first is a bank payment of 275 for rent. How this should have been recorded? Bank credit, rent debit. But what happened is has been entered as 257 in the cash book. In the cash book is a book of original entry, and from cash book the same wrong figure would have been posted to the rent account as well. The cash book is a book of original entry as well as a T account, right, for cash or bank. So the double entry is part of the double entry is completed in this day book. So if I have entered a wrong transaction in a day book, the same wrong, if I've entered the wrong amount in the daybook, the same wrong amount would have been carried forward to the T account as well. So 275, instead of recording 275, I recorded this as 257. So bank was credited with 257 and rent was also debited with 257. Would this error be revealed by the trial balance? No, it won't be identified because this is an error of original entry. We are not looking for such errors. Moreover, one more tip, if you are looking for errors which are identified by the trial balance, look for its correcting entry. If the correcting entry involves the suspense account, this means that this error will be identified by the trial balance. It will be revealed by the trial balance, but this entry doesn't involve suspense account. The transaction was unrestated, so you have to increase the transaction amount by again making an entry on the credit side by bank and debiting rent account as well. So suspense account isn't involved, this error won't be revealed. Moving towards second, a discount received of 47 has been entered twice in the account. Which account? In the discount received account, yani discount received has been credited twice. Will this error be revealed by the trial balance? Yes, this will be revealed because the error is just in one account. It isn't affecting any other account with the same value, as was the case in error number 1. So this will be revealed by the trial balance. Moreover, how would this be corrected? If discount received has been credited twice, so I have to debit discount received with 47 and suspense account will be credited. So yes, this will be revealed. Third is the purchase of a new motor vehicle costing 12,500 has been entered in the purchases account. Purchase of a new motor vehicle was a purchase of non-current asset, a capital transaction, and it has been entered in the purchases account. Purchase account is a type of an expense account. So this is an error of principle. This shouldn't have happened. How would this error be corrected? Motor vehicle would be debited and purchases account will be credited. Does this involve suspense account? No, so it won't be revealed. Fourth is the total sales of 34,670 from the sales journal has been posted to the sales account as 34,760. So again, the problem is just in one account, and the problem isn't in the debtors account because it doesn't say anything like that. The entry was correctly entered in the day book. The day book is correct, but from when posting it to the T account, it wasn't posted correctly. However, it was posted correctly in the debtors account. So how will this be corrected? I have right now overstated my sales account. So sales account will be now debited with the difference between these two, and suspense account will be credited. So again, since suspense account is involved, trial balance will reveal this error. So 2 and 4, option C. Number 9. A suspense account was opened to record the difference on the trial balance. The following errors were then discovered. There are 2 errors. The question is, what was the opening balance on the suspense account? Okay, so let's make a suspense account. The brought down could either be on debit side or credit side. The first is the discount allowed of 2,000 had only been entered in the sales ledger control account. Okay, let's quickly make the double entry for discount allowed. How is this recorded? We know that discount allowed is an expense, so discount allowed is debited. When is discount allowed recorded is when customers make a payment to the business, so we allow them some discount. So when customers are making a payment to the business, bank would be debited and my debtor would be credited. So what happened is, when discount allowed, we know that it is recorded in which day book? In cash book, right? So it was recorded in the cash book, so bank had been correctly debited. Moreover, it also says that it was entered in the sales ledger control account. The control account is just a total debtors account, so in the debtors T account as well it was entered. So debtors part is also correct. However, it wasn't entered in the discount allowed account itself. So this part of the double entry isn't complete. Now this should have been done to correct this error. How will I correct the error? I will debit the discount allowed as this should have been done, and I will credit my suspense account to complete the double entry. The suspense account will be credited with discount allowed amounting to 2,000. The second adjustment is a check for 1500 paid for repairs. How this should have been recorded? Bank credit, repairs debit, but what happened is had been entered as 5100 in the repairs account, in just one account. The error is in just one account, which is repairs. The question is silent about bank, so in cash book this has been recorded correctly. How will I correct this error? The amount is overstated in repairs account, means overstated on the debit side. So repairs should be credited by the difference between the two. Out of 5100, 1500 has been correctly recorded, but 3600 has been overstated. So repairs will now be credited to eliminate this difference, and suspense will be debited to complete the double entry. So for repairs, suspense account will be debited. Now as we can see, the lighter side is credit side, so the brought down would be on the credit side amounting to 3600 minus 2000, 1600, which is option A, 1600 credit. Number 10. At the financial year end of a business, the following information is available. Okay, we have debit balances on the bank statement. Debit balance on the bank statement means a negative balance. Credit balance means a positive balance, but debit balance on the bank statement is a negative balance. Debit balance on the cash book is a positive balance, so opposite treatment, debit balance on bank statement is a negative balance. Then there are some unpresented checks. Lodgements not yet credited. These two items, we know that these are found in the cash book, and they are adjusted in the bank reconciliation statement because they do not appear on the bank statement due to timing differences. Lastly, we have bank charges and interest charge not yet entered in the cash book, as it is also saying that it is there in the bank statement but not in the cash book, so it will be adjusted in the updated cash book. The question is, what is the current balance in the cash book? Which balance are they asking about, the updated balance or the unadjusted balance? The unadjusted balance, right? If the question is asking about the updated balance, it would say that, or it would say that what balance would appear in the statement of financial position, so that is an updated balance. But current balance means the one that isn't updated, so we have to reach to this value. How would I do that? There are just two steps to do that. Let's first prepare a bank reconciliation statement which will help me to find out the updated cash book balance, and after that I can make my updated cash book so that I can arrive at the brought down balance, which could be on either side, because I'll have the CD balance. Okay, so bank reconciliation, we start with balance as per bank statement because that is given to us, which is $1,000 negative. It's a debit balance. Then if we start with balance as per bank statement, we subtract unpresented checks 300 and we add uncredited deposits, which is 600. So 1000 minus 1000 minus 300 plus 600 would be 700 negative balance. This is the balance as per overdraft as per updated cash book. So this is my CD value. This would be the result of the preparation of updated cash book balance, and since it's an overdraft, so the carried down would appear on the debit side amounting to 700. Now I just have to fill the account with the amounts that were there in the bank statement but not in the cash book. So, and that there is just one thing, which is the bank interest and charges amounting to 150. So they will be credited, being an expense. They are paid from the cash book. So 150 would be written on the credit side for bank interest and bank charges. This will leave us with just the opening balance, and as we can see, the shorter side, the lighter side, is the credit side. So the BD would have appeared on the credit side amounting to 700 minus 150, that would be 550. So a negative balance, 550 credit, option C. Number 11. What do the debit side closing balance carried down? Okay. Debit side closing balance carried down means the balance carried down is on the debit side, and further says that credit side opening balance brought down. So brought down is on the credit side. Represent in a sales ledger control account. Sales ledger control account. We know that sales ledger control account is a total debtors account, and they usually have debit balances. Means the brought down appears on the debit side. Why? Because it's an asset. The debtors are assets for the business. Assets have debit balances, and this represents all the amounts owed by the customers to the business. These are all the receivables. But if the brought down is on the credit side and the carried down is on the debit side, if that further becomes the brought down for the next period as well on the credit side, what does that mean? This is first of all an unusual balance in a sales ledger control account, because say debtors are the assets for the business. The BD on the credit side or the CD on the debit side represents a liability balance, a payable balance. When can this be possible? This can only be possible, for instance, if my debtor overpaid me, so I now have to return the excess value to the debtor back. That is a payable on me. That becomes a liability, that small balance. Similarly, if the debtor returned goods after making a payment for them, so that is again a liability on me to return the amount that have already been received for the goods returned. So in such scenarios, an unusual balance can be present in a sales ledger control account. This is a payable, a liability for the business in that case. So now the question is that what does these balances represent? A debit side closing balance brought down would represent owing from customers. No. Option A and B can't be right. Owing to customers, yes. Owing to customers, yes. And similarly, if that CD becomes the brought down balance on the credit side, so that would represent the same thing, that is owing to the customers, a payable. So option D is correct. Number 12. The PLCA, Purchase Ledger Control Account for Business, shows a closing balance of 7640. The following items were then discovered. There are 4 items. The question is, what was the credit balance to carry down after adjusting for these items, right? So PLCA, let's have a look at the format first. You know that PLCA, being a liability, suppliers total account, have balances brought down on the credit side. Then all the purchases are recorded on the credit side. Whatever increases the liability is recorded on the credit side, right? So if there is an interest on overdue account, cash refunds from suppliers, that is also recorded on the credit side. And anything that decreases the supplier's account, for instance returns outwards, discount received, payments to the suppliers, contra entries from the sales ledger, that is recorded on the debit side. So let's have a look at that. That 7640 is the opening balance. Let's make a T account for that. Brought down is on the 7640. Since this is the starting figure, so it will be treated as a brought down balance on the credit side, as it's a liability account. So number 1, a purchase invoice. A purchase invoice for 250 had been entered in the purchases ledger but not in the purchases journal. Oh, so it was entered in the supplier's T account, but it wasn't entered in the day book. Now we know that the source of information for the preparation of control accounts are day books. So if a transaction wasn't there in the day book, it wouldn't have been inserted in the PLC as well. Now we have to include 250 in this amount. Purchases we know are recorded on the credit side of PLCA to show an increase in balance, so 250 would be added to this value. Second is, a sales ledger contra of 630 had not been entered. Sales ledger contra is sometimes when your customer is also your supplier. So in that case, we settle the amount where the balances of the two, being a trade payable or a trade receivable, and we settle it using the double entry sales ledger control account credit and PLCA debit. This settles the common value of the transactions between the two parties, and the balance remaining could either be treated as a trade receivable or a trade payable depending upon the situation. So this should have been done, but this hasn't been done yet. So this will be recorded on the debit side of the PLCA to show a decrease in value. 630 would be debited for SLCA. Then we have a supplier's account with a debit balance of 70 had been omitted from the control account. So this is very similar to the question that we just did, that credit balances in SLC are unusual balances. Similarly, debit balances in PLC are also unusual balances. Why? Because suppliers have credit balances. They are the liabilities, but debit balance represents them being an asset for the business. So this was given to you a CD. This should have been recorded on the PLCA in the PLCA, but it wasn't recorded, so now it will be corrected by recording it in the PLCA. And on which side? PLCAs usually have their balances carried down on the debit side, but since this is an unusual balance, it represents an asset, so its CD will be on the credit side amounting to 70. When can this arise? In the same way that if you have overpaid your suppliers, so now this you are expecting the overpayment from your suppliers, so the suppliers become an asset for that amount. Similarly, if you have returned goods after making a payment for them, so now you are expecting that amount again from the suppliers. Last transaction is returns inwards. Returns inwards of 540 had been entered on the debit side of the control account. Why? Returns inwards have nothing to do with your suppliers. Returns inwards are from customers, so this shouldn't have been recorded at all in the PLCA. It has nothing to do with PLC. But since an error has been made on the debit side of the control account, so how should this be corrected? By crediting my PLCA with 540 for returns inwards. So this will give me a balance carried down figure on the debit side amounting to 7870, option D. Number 13. In a draft statement of profit or loss, 2 errors were discovered. Right. There are 2 errors. The question is, what was the effect of these errors on the draft profit for the year? We don't have to look for the correction, the effect after correcting these errors, but the effect of these 2 errors on the profit. The first is a profit of 6,000 on the disposal of equipment had been treated as a loss. Why? So if this error has been made, there was a profit, but that gain wasn't recorded in other incomes. This is again which should have been recorded in other incomes, but by not doing that, I understated my incomes. And if my incomes are understated, I know that my profit will also be understated by 6,000. Also, what I did is I recorded this as a loss, that is in my other expenses, so that overstated my expenses. And if my expenses are overstated, I know that my profit will be understated by the same value. So this error has impacted the profit in 2 ways. Number 1, by understating incomes, and number 2, by overstating expenses. So the result of this error would be an understatement of profit of $12,000. Then number 2. Second says a charge of 18,000 for the depreciation of a motor vehicle had been omitted. We haven't recorded the depreciation of 10,000. So this again means that depreciation expense has been understated by 18,000 in the statement of profit or loss, which means that if my expenses are understated, my profit would be overstated by the value 18,000. So the impact of first transaction is an understatement of 12,000, and the second one is an overstatement in profit by 18,000. So the net impact would be plus 18,000 to show an increase, minus 12,000 to show the understatement. That would be the net impact would be my profit would be overstated by 6,000. The individual impacts are these, but the net impact of the two would be an overstatement of 6,000, option A. Number 14. At the beginning of the financial year on 1st January, a business shows an accrual on the rent account of 600. Okay, so this is an accrued balance. An expense account has an accrued balance. Let's make the T account. We know that if an expense is accrued, that represents a liability, which just means that we have incurred an expense but we haven't paid for that expense yet. So this is a liability on us, this is a payable, it will be paid in future, and this shows an opening balance. So on 1st July, this will appear, the brought down balance on a liability appears on the credit side. So July 1st brought down is 600. Then during the financial year, payments were made for rent as described below. So payments, whenever payments are made, our bank account will be credited and the rent account will be debited. So these represent all the payments. Let's insert these as well. On 26th July, paid 3 months rent to 31st July. Okay, so July 26 bank amounting to 900. This represents payments of 3 months. Which 3 months? The last month is July. So July and the previous 2 months, that would be May and June, and last is July. So July is the first month of the financial year and the previous 2 months are May and June of the last year. This represents what? The accrual, the brought down, this figure. So the first payment has settled the accrual balance as well as the first month payment. So this is very good. Then on 11 November 11, again through bank, paid 4 months rent to 30th November amounting to 1200. So the next 4 months after July is August, September, October and November. Very good. Then again 4 months rent to 31st March. This was paid on March 15 from bank amounting to same. Now the next 4 months, December, January, February and March. That's it. There are no other payments. The question is, which amount is to be shown as a prepayment or accrual for rent at the end of the financial year? We have made the payments till March. And what is the year end? June. This means that after March, April, May, June, 3 months. April, May and June, 3 months of payment hasn't been paid. However, the expense was utilized, the expense was incurred. I haven't made the payment yet. So is this an accrual or a prepayment? Of course it's an accrual because an expense has been incurred but it hasn't been paid by the year end. An accrual for 3 months. Accrual carried down has been asked because the brought down was already there for this year. Carried down accrual being a liability will be shown on which side? On the debit side, so that it becomes a brought down balance on the credit side. So on 30th June there will be a carried down balance for 3 months of rent expense, and what would be the value? As we can see, that's it. 4 months represent 1200, 3 months represent 900, so per month payment is $300. 3 months, 300 into 3 is $900 of accrual. That is option C. If the question was to find out the figure which will go in the statement of profit or loss for accrual, that would be on the credit side as a statement of profit or loss or income statement, which would be the balancing figure, and that would be 3600. Or this can also be calculated by multiplying $300 was the per month payment with 12 months, because we know that in income statement or statement of profit or loss, by following the accruals or matching concept, the expense which belongs to current year goes irrespective of its timing of payment, right? So even if in the current year you have made payments for the last year, you have made payments for the current year, and even if there is a prepayment for the next year, only in income statement what will go? The payment, that the expense that relates to the current year. Question number 15. A sole trader sold goods at a markup of 50%. In markup we know that if profit is sales minus cost, so in markup profit is 50, my sales would be standing at 150% and my cost would be at 100%. During the year he withdrew goods for his own use. The drawings account was debited and the sales account was credited with goods at the selling price of 5400. Why? What was the effect of these errors on the profit for the year? Again, the effect on the profit because of these errors. First of all, this was an inventory drawings transaction. How this should have been recorded? By debiting drawings and by crediting purchases account. By crediting sales account with 5400, the impact of this transaction was that it overstated my sales by 5400, which definitely overstated my profit as well by 5400. The second impact of this transaction was on purchases. Were the purchases credited? No. This means that the purchases weren't reduced. So my purchases would be overstated. And that would have overstated my cost of sales. If my cost of sales are overstated, this means that my profit would be understated. But with what value? 5400. No. We know that purchases are recorded on cost, so inventory drawings are credited at their cost in the purchases account and also in the drawings account. What is the cost? Can we find that out? Yes, we can using the markup. If I have to find out the cost, so unknown is cost. Cost is unknown. Unknown upon known is 150. The selling price into 5400, the known figure, which is 5400. That would give me a cost of 3600. So first impact, profit would be overstated by 5400. Second impact, profit would be understated by 3600. So the net impact would be plus 5400 minus 3600. That would be 1800 overstated. Right? So that is option A. My profit would be overstated by 1800. Number 16. X and Y are in partnership. They do not have a partnership agreement. So which statement is correct? When there is no partnership agreement, we know that there are certain conditions. For instance, there can't be interest on capital, no interest on drawings, no salaries to partners. Profits and losses are shared equally, and if the partner has given loan to the partnership business, the interest rate on that would be 5%, not more, not less. So option A is interest on capital is earned at 5%. No, there is no interest on capital. Second is interest on drawings is charged at no, there is no interest on drawings. Third is interest on partners loan is earned at 5. Yes, this is correct. Not more, not less. So option D is profits and losses are shared in the ratio of capital. No, they are shared equally. So C is correct. Number 17. Yasmin and Zara are in partnership sharing profits and losses in the ratio 3:2 respectively. After providing Zara, so Zara receives a salary of 8,000 per annum. During the partnership's first year of trading, Yasmin's drawing totaled 11,500 and the partnership made a profit of 7,000 before appropriation. Okay, so profit for the year is 7,000 and the question is, what was the closing debit balance on Yasmin's current account? Right, so there isn't any opening balance since this is the first year of business. Yasmin's current account, no balance brought down. So in current account, what goes on the debit side is drawings, interest on drawings if there is a loss, share of loss, and on the credit side, anything that increases the current account balance, for instance salaries, commission, bonus, interest on capital, interest on loan and profit share. What do we have in this question is, there is a partnership salary, but that is for Zara. We are maintaining the current account for Yasmin, so this won't appear. And Yasmin's drawings are 11,500, so that will be debited, 11,500. And then we are just given with the profit. So profit after appropriation is divided between the two partners. So profit for the year was 7,000 and we will give the salary to Zara amounting to 8,000. Oh, so that has converted the profit into a loss. This is the residual loss figure. This will be distributed amongst the two, Yasmin and Zara, in the ratio 3:2. So Yasmin's share of loss would be 600. That would appear on the debit side, share of loss 600. The question was, what was the closing debit balance on Yasmin's current account? So the CD would be on the credit side amounting to 12,100, and the brought down would then appear on the debit side for the next period amounting to the same 12,100. So that is option D. Number 18. The question says a company is planning to invest funds in a project. Okay. Further, it says that the current interest rates are high and the company wishes to avoid a change in the control of shareholders. So it is looking for finance because it wants to invest in a project, and there are two conditions: that interest rates are high at the moment and they have to finance this project, but they are not willing to lose control of the shareholders. So which type of finance should they use to fund the project? This is the question. Where option A is a bonus issue. Can bonus issue raise finance? No. No finance is raised through bonus issue. It is just a distribution of equity from reserves to the share capital, because share capital is credited and on the debit side the reserves are debited to finance the bonus issue. This is given at the time when the business is finding it difficult to make cash dividend payments. So bonus issue is sometimes given in that case. That doesn't raise any finance, so this can't fulfill the purpose. This can't be right. Option B is a fully subscribed rights issue. Rights issue, they do raise finance, okay, because bank or cash is debited when there are rights issue, and on the credit side we credit ordinary share capital account and the share premium account as well. So, and the question is also saying that they are fully subscribed, so all the shareholders will take this. Moreover, this is for the current shareholders only. No new shareholders are involved. So this will fulfill the condition that the company won't lose. There is no dilution of ownership if rights issue are issued. Moreover, there are no interest on rights issue. There is no interest on return to the shareholders. We pay dividends, but only when the business thinks it is able to pay the dividends. Let's have a look at option C and D as well. Option C says an issue of debentures. Okay, so if the company issues debentures, first, the second condition would be met, that it will avoid the change in control of shareholders because no new shareholders would come in the company. Of course, a liability will be established, but the second condition won't be fulfilled, which is they want to avoid the interest rates which are high at the moment, and debentures will bring the interest rates to the company, as the return on debentures is interest. So that is a big no, because then the company will have to pay high interest to the debenture holders. Option D is a new issue of shares. This again fulfills one condition, that interest rates won't be involved because the return to shareholders is in the form of dividends and that are discretionary. But a new issue of shares would bring in new shareholders, and that would dilute the shareholdings of the company, of the current shareholders. So this is again a no. So the most feasible option at the moment is option B, as no new shareholders would come in the business and no interest rates would also be involved. Number 19. A company's statement of financial position at the beginning of the financial year on 1st January is shown. We have share capital, share premium, revaluation, general reserve and retained earnings. So all reserves are there. The profit for the year ended 31st December was 680,000. Right. During the year the following took place. Let's see the question first. What was the increase in the company's equity and reserves for the financial year? Okay, so we have the brought down balances. We have to either we find out the carried down balances by making an adjustment for all these transactions. The difference would be the increase, or we just make the adjustments and the adjustments would result in the increase, right? So let's make the adjustments first. The profit for the year was 680,000. Where is this added in the share equity and reserves? In the retained earnings, 680,000 would be added, so this will increase the retained earnings. So the first increase is this. Then what happened is the business issued 500,000 ordinary shares of $1 each at a price of 2.5 each. So they were issued at a premium. This means that the share capital would be credited at 500,000 at par value, which is $1, and the share premium would also be credited by the difference between par value and the issue price. So 2.5 minus 1, 1.5 into 500,000 would be my share premium, that is 750,000, and bank would be debited by 1250,000. So share capital will increase by where's share capital? Yes, by 500,000, and my share premium would also increase by 750,000. Then second is an upward revaluation of non-current assets of 250,000. Wow. So in upward revaluation, we credit the revaluation reserve and we debit the non-current asset. The value is set 250,000, so this will increase the revaluation reserve by 250,000. Third, a transfer of 100,000 from retained earnings to general reserve. So from one reserve to another reserve. So retained earnings would be subtracted 100,000 and this will be added to the general reserve of 100,000. Last is a payment of ordinary dividends of 125,000. Where are they paid from? From the retained earnings, so minus 125,000. So what was the increase? We either calculate the balances of all the equity and reserves accounts, or we just total the causes of increase, which is the adjustments. So that would be 500,000 plus 750,000 plus 250,000 plus 100,000 plus 680,000 minus 100,000 minus 125,000. That would give me 2055,000. Option C. Question number 20. Who are the internal users of accounting information? Internal users are the one working for the company. So let's look for the answer. Customers, no, they aren't. They do not work for the company. They are external users of the financial statements. Directors, yes, they are the managers. They are the ones who are managing the affairs, the operations of the business. So yes, they are the internal users of the accounting information. Option C is potential investors. No, the current investors, of course, they are the internal users, but potential are the ones who are thinking whether to invest in the company or not by looking at the financial statements. So they are the external users. Third is providers of finance. Yes, they are also not working for the company, not working in the company. So the banks and other institutes, they are also the external users of finance. So option B only. Number 21. Which actions will make the asset test ratio worse? How is asset test ratio calculated? Current assets minus closing inventory upon current liabilities, right? So it shows the most liquid assets of the business after eliminating the least liquid asset, that is closing inventory. So how can this become worse? Let's see the effect on each which can make the ratio worse. For instance, on a broader way, if my numerator decreases and or my denominator increases, that will reduce the asset test ratio and that will make it worse, right? When can the numerator reduce? Either my current assets reduce, so the whole figure would reduce, or my closing inventory is increased, right? So if I am subtracting a bigger value from current assets, the ultimate result would be a reduction in numerator, or if my current liabilities increase. So let's have a look at the actions. Owner taking goods for own use. If owner is taking goods for own use, that will reduce the closing inventory, right? That will reduce the inventory amount from the business. So are we looking for that? No, that will make it good. Closing inventory should increase to make the ratio worse. So this can't be right. Then number 2 is paying trade payables. That would reduce my current liabilities. So that is not also what we are looking for. We want an increase in current liabilities. So this is also not right. Number 3 is purchasing a non-current asset by check. So non-current assets do not have any impact on liquid asset test ratio. They are not involved in the equation, in the formula. But check means my bank would reduce. That is, my current assets will reduce, and that is what we are looking for to make the ratio worse. So this is right. Well, the last is repaying a non-current liability. Although non-current liabilities aren't part of the formula, but non-current liabilities will be paid using bank or cash, bank usually. So again, my bank balance will reduce, making the ratio worse. So option D, 3 and 4 only. Number 22, a business provided the following information relating to its most recent financial period. We have sales, purchases, inwards, outwards, carriage, opening and closing inventory. Okay. Question is, what is the rate of inventory turnover in times for the period? How is rate of inventory turnover calculated in times? Cost of sales upon average inventory. Do we have average inventory? We can find out average inventory. Let's do that. Average inventory is opening inventory plus closing inventory divided by 2. So opening is 170, closing is 210,000 divided by 2. So average inventory would be 190,000. Okay. Then second is cost of sales. We aren't given cost of sales, but we can find out. Cost of sales is opening inventory plus purchases. If there are any purchases returns, they are subtracted, but they aren't part of the information given. If there are any inventory drawings, they are also subtracted. Plus carriage inwards minus closing inventory. So opening inventory is 170,000 plus purchases 700,000 plus carriage inwards 80,000 minus closing inventory 210,000. Carriage outwards won't be used. Carriage outwards aren't part of the cost of sales. They are recorded in expenses, operating expenses after GP. So and sales revenue is also given just to confuse you. It is not used anywhere in the inventory turnover formula. So my cost of sales would be 740,000. So I now have both the things. So 740,000 upon 190,000, that would be 3.89 times option B. Number 23, costing part. Okay, actual output for a business is higher than the budgeted output. What is the scenario? Actual output is higher than the what we budgeted is less and what we produced is more. Which cost will be the same? Will still be the same as budgeted, even if your actual output is more. Fixed cost per unit. No. Fixed cost per unit will decrease. Why? When your output will when more units will be produced, or when output will increase, fixed cost per unit would decrease. Why? Because total fixed cost would be spread over more units. So per unit it will reduce. So we want the one which will remain the same. Second is total fixed cost. Yes, this will remain the same even if you have produced more. So to a certain level of activity, this will remain same. So this is right. In total it will remain same. Third is total variable cost. No, this is a direct cost. It varies with the production. It varies with the number of units produced. So if you are producing more units, of course total variable cost will increase. However, variable cost per unit will remain the same. Per unit it will be incurred same. So 2 and 4 are correct. Number 24. A business uses the first in first out method of inventory valuation. There was no opening inventory. The business purchased direct materials during July as follows. Okay, so 2000 kg purchases amounting to 25, then 3000 kg of purchases amounting to 28 cost per kg. Each unit required 4 kg of direct materials. The labor cost for each unit was 42. The fixed overheads are also there, 85,000. In July, 1000 units were produced, but only 800 were sold. Question is, what is the average direct cost for each unit? The direct cost is being asked, so we know that these 85,000 of overheads won't be used. They are indirect cost to the business. So we have two costs which are direct, that is direct material cost and direct labor cost. And direct labor cost per unit is also given to us, which is 42. We don't have to do anything for that. We just have to add this to the direct material cost per unit. Direct material cost per unit needs to be calculated. It says over here that each unit requires 4 kg of direct material. Can I first calculate that how many kgs were used in total to produce 1000 units? If 4 kg is used for 1 unit and 1000 units were produced, this means that 4000 kgs of the raw material was used. How many kgs of direct material have we purchased in July? 2000 plus 3000 means 5000 have been purchased, but only 4000 was used to produce the goods. And this 4000 would have been used in the first in first out method, in the first in first out sequence. That first this 2000 would have been used, and then secondly from this 3000 2000 would have been used. So 1000 was the closing value, closing inventory. Now this is the total kg. Let's first calculate the total direct material cost, and then we can convert it to per unit. So 2000 kg was bought at a price of 25 per kg dollars, plus then again 2000 would have been bought for $28. Now, as you can see that I am using 2000 over here, not 3000, although all 3000 was purchased at $28. However, when I want to calculate the direct cost for each unit, I will only use the units produced. From the 1000 kg remaining, no units were produced, so no cost would be used for in that calculation. So 2000 kg plus 2000 into 25 plus 2000 into 28 would be a total cost of $106,000. We are looking for per unit, so let's divide it by 1000 units, and that would be $106. This is direct material. Add direct labor to it, which is given already 42, so this will be $148 of direct cost. Overheads will be ignored here because direct cost was asked. So A. 25. A business provides accounting services to its clients, right? Service sector business. One of its employees takes 30 hours to complete a job. The employee's hourly rate is 25. The business absorbs its overheads at the rate of $10 per labor hour. Okay, so overheads. Then it adds 20% of the profit, 20% profit to the total cost of the job. The question is, what is the total price of the job charged to the client? How much will we quote to our client for this job? Now there are three things which needs to be incorporated to calculate the total price. The first one would be the direct cost, which is the cost of the employee that will provide services to the clients. And how is that calculated? He takes 30 hours to do the job, and each hour he is paid $25. So 30 into 25, $750. Then overheads will also be included in this. They are absorbed at a rate of $10 per labor hour. So $10, and how many hours is he working? 30 hours. So 300. Lastly, we add profit. So profit would be, what is the total cost? The total cost is $1050, and profit would be 20% of this value, 1050. That will be 210. We won't be charging cost to cost, but we'll add the profit element as well. So 1050 plus 210, 1260. This is the price that will be quoted to the client, option D. A business operates a staff cafeteria at a cost of 12,000, right? What is the most appropriate basis for apportioning this overhead cost? Staff cafeteria cost. So any employee related cost, how this should be apportioned? This is apportioned, the most suitable basis to apportion an employee related cost is number of employees. Floor area, no, that is usually used for building related expenses. Direct labor hours, again, no. Carrying value of cafeteria equipment, no. Number of employees is the most suitable always to apportion such overheads. Number 27. A business has the following budgeted and actual results for a month. We have budgeted fixed overheads, we have actual fixed overheads, and we have under absorption. Okay, there's under absorption. When is there under absorption? When we absorb less than what we actually incur. What does it say? The fixed overheads are absorbed per unit. Okay, so this is the OAR, and the basis, the number of units in total are 118,000. The question is, what is the actual level of activity in units? So very interesting. There's a formula. to calculate under or over absorption, and using that formula we can find out the level of activity. What is that? When the actual overheads, the difference between actual overheads and absorbed overheads, if the result is under absorption, the answer would be positive. Why? Because that would represent the actual overheads are more than the absorbed ones. We absorbed less. That is why there is under absorption. So actual overheads are already given to us. These were 360,000 minus absorbed. How do we calculate absorbed? We multiply overhead absorption rate with the actual activity, or the units. In this case we have units. Do we have OAR? No. Can we calculate OAR? Yes. OAR is total overheads, fixed overheads, which is 354,000 budgeted, right? We use budgeted figures to calculate OAR, and the budgeted number of units it is being absorbed per unit, they are 118,000. This will give me an OAR of $3. So $3 into actual activity, that is not told. That is what we are looking for in the question. So let's assume it's X is equals to 3,000. So 3x is equals to 360 minus 3, that is 357,000, and x is equals to 119,000. These are the units that were actually produced. We were expecting 118,000. So when the actual production is more than the budgeted production, there is under absorption. That is option B. 28. Which statement concerning break-even charts is correct? Option A. At the break-even point, revenue and fixed cost intersect the chart. At break-even point, revenue and total cost intersect the chart, not the fixed cost. This is not right. B is choices of optimal activity levels cannot be made using break. Yes, they are made using break-even charts. That how many units should be produced in order to break even, when can break even be reduced, when can it be increased, that is decided using the chart. So this is also not correct. C is cost and revenue are assumed to show a linear behavior. Yes, these are correct. This means that cost per unit, variable cost per unit, and selling price per unit, when that is kept constant, that they do show linear behavior, a linear graph. So for instance, if I make the chart, so a variable cost line is like this. So this is a linear line, and same goes for revenue. So revenue line is also like this. It is not like when it is going up, down, or there is a constant change. It's not like that. So this is linear. Option D is revenue in excess of fixed cost represents margin of safety. No, revenue in excess of break even represents margin of safety. That is right as well. Second last question. Sorry. A business provides the following information. We have break even point in units. We have selling price. We have CS ratio. Question. What is the effect on the break even point if unit selling price is increased by 10%? What is the selling price right now? It is $50, and if it is increased by 10% means 50 into 110%, that would be 55. So what is the impact on break even? Current break even is 4,500. We have to find out a new break even so that we can see whether there is an increase or decrease. For that we will need fixed cost upon contribution per unit, which is selling price minus variable cost. Do we have fixed cost? No. We know the selling price, which is 55. Do we know the variable cost? No. This means that these two needs to be calculated. First one is 4,500 are the break even units. We are looking for fixed cost, and we know the contribution per unit, so which is selling price 50 minus variable cost. We don't have variable cost. Let's first find out variable cost. Variable cost would be find out using the CS ratio, which is 40%. Contribution to sales ratio means contribution per unit upon selling price per unit, and contribution per unit is what? Open this formula. Contribution per unit is selling price per unit minus variable cost per unit upon selling price. Contribution per unit upon sales, CS ratio. So this is what 0.4 is equals to selling price is 50, right? The current, not after increasing it by 10%, because 4500 units were produced at when the CS ratio was 40%. So we'll keep the old selling price minus variable cost. This is unknown upon the same 50. That would be 0.4 into 50 minus 50, so 30 would be the variable cost. If I plug this value in this formula, so 4500 is equals to, fixed costs are still unknown, 50 minus 30. So 20 into 4500, fixed cost will be 90,000. Now I can find out my new break even. Fixed costs are 90,000 upon new selling price is 55. The question is silent about variable cost, so it won't change. 55 minus 30, that would be 3600. The old break even was 4500, the new break even is 3600. So 4500 minus 3600 would be a reduction of 900 units if we increase the selling price. Sorry, a decrease of 900 units, option D. Okay, last, when might the application of CVP analysis be ineffective? Let's read from option D. Option D says when there are fixed costs as well as variable costs. So no, it can't be ineffective. That is how it works. We find out the CPU, then we subtract the fixed cost. So this is not right. When output is likely to fall, no, we assume, we make estimates, we see the results of certain changes. For instance, when units are increased or reduced, when selling prices increased or decreased. Similarly, the changes in variable cost, to find out different results. So this is not right. B is when an increase in the price of direct labor is expected. No. Again, we make certain assumptions to find out different results, so that we can see that which is working the best, which is maximizing the contribution or the profit. Option A is when a change in production method is planned. Yes, this is not right, because CVP analysis has certain assumptions, and this assumption is kept constant, that the production method will remain constant. For instance, if it is following a labor intensive method or a capital intensive method, that won't change during the production or during when other changes are being applied. So this is not right. The rest can be implemented to find out different results. So these are all right, B, C and D. Right? So we are done with this paper, and I hope it was clear. If there are any confusion, you can ask them in the comment section, and I'll make sure that I answer them as accurately as I can. So see you in the next one. Take care. Allah Hafiz.